Um, Hello, welcome back to the continuing lecture in sorry, principles of finance. And the topic we've been covering so far, right, is the return on investment and macroeconomics. Now, so in our last class, we discussed what types of bonds are out there and how they are classified, and um, and the reason we were talking about the basics of bonds was to understand what is the open market operation. And remember, open market operation is just one tool out of three tools that the Federal Reserve has under its control to implement monetary policy. And once again, the monetary policy is to increase or decrease money supply to stimulate the economy or to cool off the economy. And it goes through the market mechanism. And the easiest tool to affect the interest rate is the discount rate, but actually more intricate mechanism or more pervasive mechanism, pervasive tool and smooth pervasive tool, most frequently preferred tool by the Federal Reserve is the open market operation. So we're going to look into open market operation first. And I explained in our last video what is the definition of open market. It's a bond market open to anybody, individual or institutional, domestic or foreign, right? So, so basically, the Federal Reserve is intervening, entering the bond market and sell or buy back the Treasury securities, right? That's in the essence what the open market operation is. But let's take a look at the mechanism. First of all, let's assume a zero coupon U.S. Treasury bond with 30 years to maturity. Okay, so that means this is going to be a discount bond because it's zero coupon bond and it matures in 30 years, right? And obviously it will have to sell below its par value. So the par value is the face value, right? 1,000. And the selling price, this means the price of the Treasury. So that's the selling price of the Treasury. So, so therefore the price of the Treasury, selling price must be way below the face value. And let's say that is $500, right? Selling price is $500. So 30 years later, you will realize 100% holding period return, right? If you hold it until for 30 years, right? So that $500 is capital gains, right? But it's also called bond discount. The difference between the two is called bond discount because that's the discounted. That's how much it is selling for. $500 is how much it is selling for, and it is discounted by $500 from the face value. So then if you think about it, the return on investment, return on the Treasury bond, this 30-year Treasury bond, is calculated this way. Isn't it right? Value minus selling price of the bond, which is capital gains, divided by the selling price of the bond. Because the selling price of the bond is your initial investment. You have to pay that, right? You have to pay that $500 to buy this bond, to invest in this bond. The cost or the initial investment and capital gains. And that's return on investment. In other words, this is the holding period return. But this holding period return has a special designation. A special designation is the risk-free return. Risk-free return. Okay, risk-free return. Why is it risk-free? You remember in the earlier videos, I said bank interest rate, right? Like in a savings account interest rate or CD, one of the CD, are risk-free because the banks will have to pay this to you when the CDs mature and you redeem your money, right? And most of the banks in the U.S., all the commercial banks are basically FDIC insured. FDIC is a Federal Deposit Insurance Corporation. So by law, your deposit is guaranteed up to $250,000. It's all insured, right? That is one, risk-free return. And the other one is Treasury, U.S. Treasury. Why? We're going to get to that more into the reason behind it shortly. But think about it. No other bonds, no corporate or government, right, are safer than U.S. Treasury. Think about it. U.S. federal government is the safest borrower in the world. Why is that the case? Why is that the case? Let's take a look. If I click on it. Now, think about it. U.S. Treasury has the highest credit rating, AAA, right? AAA, that's the credit rating. We're going to also talk about this later. AAA, double A, single A, triple B, double B, and single B. Now, if someone's borrowing money, what are you going to look for? I mean, you would be, when you're lending money, you will be concerned. The worst concern is your biggest concern is the default risk, right? Now, someone with the lowest default risk, how do you know if that person has lowest default risk? Well, first, you'll have to look at this person's wealth, this person's income, right? You might say, you look at the person's credit history, blah, blah, blah. Yeah, but where did that credit history come from? Where does that credit history come from? It comes from the elements like, of course, how much credit he incurred in the past and how well he has, paid back and all these things. But before all that credit history, what is the most fundamental thing you would look into? This person's annual income and his wealth level. Income and wealth are actually not the same thing. They are two different things because income is the result of your economic activity. In other words, income is the result of your income, your labor income, right? There's also capital income, not labor income. But let's say as long as you have a job, right? Solid, permanent, secure job, with a job security, and you have, a constant, steady level of income, you have to pay back, right? Makes sense? you have solvency, right? They want, if your annual income is $50,000, they won't lend you up to $50,000, but at least they will lend you up to a certain percentage, 50% of your annual income, or 70%. Now, and then next, you would look at this person's wealth, right? If this person doesn't have a job, how much wealth does he have? Wealth is the basically a stockpile of savings from your income. Isn't that right? Wealth is the stockpile. And if you have inherited wealth, like real estate, or a huge savings, that is also your wealth. But these are not labor income. These are not, the wealth can be the source of income, because with the wealth, if you lend it out, if you invest it, there is income from it. But that income is not called earned income or labor income. Those are called capital income or investment income. Makes sense? But in general, if the borrower has a solid job, permanent, solid occupation with job security, and has a steady income source, then his or her solvency, is proven. Now, if it is a nation, if it is a country, national government, what is this? And they are borrowing, national governments are borrowing. So then what do you look at to make sure that they are solvent, they have, ability to pay back? You look, what is the income of a national government? Income of any national government, or major source of income for any national government or municipal government or local governments. So tax revenue, isn't it right? Tax revenue. Now, the tax revenue is some percentage of the GDP, right? Gross domestic output, right? Some percentage. All countries, GDP tax revenue is some percentage of the GDP. Make sense? So then think about it. Who has the highest level of tax revenue? Which government has the highest tax revenue? Of course, the government of the country whose GDP is the greatest. And who has the highest GDP in the world? U.S. And that's an approximate GDP comparison of major economies. And as of 2018, U.S. had single-handedly, U.S. made about $20 trillion. European Union, about $16 trillion. China, about $13 trillion. Japan, $5 trillion. So it goes without saying, no other government or corporations has more revenue, more income than the U.S. government. So the payback ability of U.S. government is the highest in the world. And besides, think about it. U.S. government won't go out, it won't collapse until there is still the last corporation and the last individual paying taxes, right? U.S. government will collapse only when when the last corporation and the last individual paying taxes have fallen. Make sense? And all the national governments, by the analogy, it's the same thing. Japanese government will not go away until the last Japanese corporation paying taxes to the Japanese government, or last individual paying taxes, are still around. And when they are gone, then they will collapse. European Union, all, UK, all, right? So that's why U.S. government debt is the safest debt in the world. Okay. Now there are a couple of other reasons, but we're going to get to that later. So that explains why the return on the U.S. Treasury is called risk-free. Okay. Now, so now let's think about it. If what's going to happen if the Federal Reserve sells more Treasury securities? If Federal Reserve, actually Treasury security is not issued by the Federal Reserve, it's issued by the Treasury Department. So Federal Reserve is like a window. The Federal Reserve is like a broker for U.S. Treasury Department. So through Reserve, they sell Treasury securities. And suppose Federal Reserve sells more Treasury securities, what's going to happen to the price? The price will go down. The selling price of the Treasury will go down. Isn't it obvious that this is a simple law of demand and supply? When there is more supply, right? When the demand is steady, what's going to happen to the price? The price will go down, right? Think about it. If the price goes down, if the selling price goes down, what's going to happen to the risk-free? What's going to happen to the return? Now, this is a very simple and straightforward mathematical logic, but I've seen a lot of people who cannot make this, who cannot just perform this, just very basic logical thinking. Now, this number, this face value is a constant, isn't it right? Face value, because it's $1,000, no matter what, $1,000, right? And this goes down, right? So what's going to happen to the numerator? This will go up, isn't it right? The difference will widen, right? Difference will widen. That means the numerator will go up. And also, since this is going down, right? Price is going down, selling price is going down. So what's going to happen to the whole fraction? The whole fraction will have to go up. Make sense? The whole fraction will have to go up. Now, the numerator goes up, denominator goes down, the whole fraction goes up. This is just the logic, simple, straightforward mathematical logic, nothing else. You don't need to plug in the numbers there, right? And if you're not capable of, carrying out this mathematical, basic, very fundamental mathematical logic, then you have to seriously question your own, mental alertness, mental discipline, right? Usually, people in the liberal arts are weak in this type of mental discipline. They all just hate the word discipline in the first place. It's like, it's taking away the freedom. No, for your own sake, being sharp, right? Intellectually sharp is the best the freedom can have. It's not like the best thing about if you think just being haywire and loosey-goosey, if you think that's freedom, no. Unbridled, undisciplined, frameless, unframed thinking, that's not freedom, right? That's just that's just chaos. You need to have that acute mental sharpness. And it comes from this type of training. So anyway, the bottom line is, this explains, okay, so first, the Federal Reserve sells more Treasury securities, and then due to law of demand and supply, price goes down, therefore the risk-free return goes up. When the risk-free return goes up, what should happen to the rest of the bond market? Think about it. In the bond market, Federal Reserve, U.S. Treasury, right? U.S. Treasury Department, U.S. government, federal government, is the biggest player and the most influential player. Why? It's the safest borrower. And when the safest borrower is paying you, paying the investor, higher return, then what should the other borrowers do? They will have to follow, don't you think? When the safest guy is paying, safest borrower is paying higher rate, you cannot just be complacent and just still maintain your low return. Otherwise, you will lose all your investors to the U.S. Treasury. So you'll have to follow suit. You have to also pay a higher return. So all the other bonds, corporate bonds, municipal bonds, they all have to pay higher interest, higher return, right? Higher coupon rate. So overall interest rate in the market goes. This is not only the bond market. Now remember, think about it. Didn't we look into 3 possible sources of business credit? One is, through the bond market, from sale of bonds. Second, they can borrow from institutional lenders such as banks. Now then, think about it. Banks are also competitors. Banks are competing for borrowers, competing with the bond market for borrowers, right? And if the bond market is paying higher return, higher interest, then the banks will have to also follow, right? So then the overall interest rate in the economy goes up, right? And then therefore, money supply throughout the economy, sells more. So as the interest rate goes up, then what's going to happen? When the interest rate goes up, it becomes more difficult to borrow. If you're a borrower, I was saying, banks are competing for. That's true. Banks are competing with the bond market, and in the bond market, corporate bonds are competing with Treasury. So when the rate goes down, I should have started out with this, and I was explaining this case. If the rate goes down, this is a good news for the borrower. But when the rate goes up, think about it. If the risk-free return goes up, right? Overall interest rate goes up. Now, overall interest rate going up is a nice thing for the lender if you're lending money, right? If you're lending money, so you will put your money into the bonds, into the banks as the overall interest rate goes up. But then what's going to happen to the money supply? Now, when you buy bonds, right? Or when you put your money into the bank, right? Money flows from the economy to the banking industry, and the banking industry, from the banking industry, also to the Federal Reserve. So what happens to the money supply throughout the economy? Money supply in the economy goes down because money flows from the economy to the Federal Reserve. And this is a bad this is a bad news for the borrowers. Why? To the lenders, this is a good news because um, you get higher return on your money, but to the borrowers, the burden of paying higher interest is growing because it's so onerous and burdensome, right? Because you have to pay a higher return, higher interest rate, right? Although and to and overall interest rate is going up, the burden is higher. Uh, so generally, this discourages borrowing, and as it discourages borrowing, money supply throughout the economy goes down, right? Companies will uh, postpone their expansion plan. They had planned for expansion, but because the borrowing cost is higher, they postpone the expansion plan. Then the hiring goes down, right? Overall economic output goes down, and it's exactly the mirror image. When Federal Reserve buys back, uh, they it's actually buying back. There were Treasury securities held by the investors throughout the economy, and the Federal Reserve buys back, right? Um, the Treasury securities, and buying means what? Added demand, increased demand. As the demand uh, gets stronger, what's going to happen to the price? The price goes up. Then what happens to the return? This price goes up. This is a constant. This is always $1,000. This is a constant. This goes up. So the difference, or the bond discount, it narrows, right? It gets smaller. So this goes down, and this goes up. So what happens? Numerator goes down, denominator goes up, the whole fraction goes down. So risk-free return goes down. And since the safest borrower in the financial market lowers the safest player and the biggest player in the market lowers the interest rate, then all the other corporations or municipal governments can lower the interest rate. So from the borrower's perspective, this is a good news. From the lender's perspective, this is a bad news. But from the borrower's perspective, this is a good news because burden of the borrowing cost, also called cost of capital, right? Cost for borrowing capital, right? Borrowing cost goes down. And as the borrowing cost goes down, they borrow more. As they borrow more, and then they put it onto expansion plan and new ventures, and so it increases employment, not only of labor but also of resources. Therefore, money supply throughout the economy goes up, and the overall output of the economy goes up. Okay, economy grows. So now the picture is complete. If you think about it, this schematic picture is complete because previously what I'm saying is, if you look at this, right? Since I already explained this, you understand the this inverse relationship between the interest rate and the GDP, or the output of the economy. But it doesn't explain what causes the interest rate to go down, or it doesn't what causes the interest rate to go. In other words, is missing the picture, the mechanism before the change in interest rate. Of course, there are two sources of interest rate changes. One is endogenous, the other one is exogenous. Endogenous means, it's coming from within the system, coming from the system itself. Exogenous means, from an outside source. Okay, so actually, this picture, this diagram is showing you the exogenous cause of change in interest rate, exogenous, because Federal Reserve is intervening, right? Federal Reserve is intervening. It's an exogenous. Endogenous cause of interest rate change is the business cycle, right? When business is economy is good, economy is booming, more businesses will want to expand, right? And as they want to expand, they will need capital injection. So how do they supply that capital? They go to the market, right? So naturally or inherently, there is a reason for upward pressure on interest rate, because as they try to borrow more, that's the demand. So that pushes up the interest rate, right? Borrowing cost. That's endogenous. But outside the cyclical, a factor. In other words, if it is not coming from the business cycle, then it is due to the intervention of the Federal Reserve. This intervention is called open market operation. Okay, and this completes the picture because it explains what happens, happens before interest rate goes down or goes up, and why it is causing the interest rate to go up or to go down. Okay, so that is the open market operation. So in our next video, we'll discuss, how they implement, how they change money supply, how they implement monetary policy through discount rate and reserve ratio. So that's it for this segment of the video. And I will see you guys in the next video. Okay, stop recording.